Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Saturday, August 22nd, 2015, and the title of this week's extremely important audio blog is Economic Mother Nature Always Wins. It is Saturday morning as I awake following this week's carnage. Frankly, said carnage has been worsening each day since history's largest, most destructive fiat Ponzi scheme peaked in the 2000 dot-com bubble and broke when peak debt was reached in 2008. However, care of history's largest, most destructive scheme of money printing, market manipulation, and propaganda, said game was lengthened an additional 7 years, leading us to 2015, when the big one I've spoken of since 2011's global meltdown 2 has finally arrived. And yes, it unequivocally has, as at this point, particularly since last week's Chinese yuan devaluation took the final currency war nuclear. No matter what money printing, market manipulation, and propaganda schemes the central banks cook up, and believe me, they will be massive, unprecedented, and soon, they will fail to prevent economic Mother Nature and the unstoppable tsunami of reality from running over them like a bulldozer over hot tar. As I wrote last week, we have officially reached the end of belief that central banks can save us, or, more aptly put, the beginning of belief that central banks are destroying us. And when, likely very shortly, the Fed ends its 2.5-year propaganda campaign by not only raising rates, but not only not raising rates, but lowering them below zero and launching a massive, unparalleled QE4 campaign, we will have officially reached what I discussed in Thursday's article, the ultimate central bank endgame, or as I called it when QE3 supposedly ended a year ago, LOL, the Yellen reversal. For that matter, here's a sneak peek at what the title of my audio blog will be the day after this occurs, which has been sitting patiently waiting to be unveiled for several months now, i.e., ding dong, the Fed is dead. With that terrifying and validating introduction, and before I discuss the past 2 days' horrifying political, economic, and financial events, let me bring up another actionable item per another discussion I had with Miles Franklin's president and co-founder Andy Schectman on Thursday evening, who I might add just turned 45 years old on Thursday, as I will a month from now. So be sure to wish him happy birthday if you speak to him this week, given just how hard he has worked, along with his father David, to build Miles Franklin into the most reputable, customer-friendly bullion dealer in the business. Anyhow, when I called him Thursday night for an update on silver supply tightness, which he claimed, as you can imagine, was as razor thin as when I first discussed the topic on last week's article, Silver Supply a 1.5 or 2.0 out of 10, he was in Canada at our Brinks Vault in Montreal. In fact, he was dropping off a customer's gold in the vault, having traveled first to the city where the gold was being held, and then directly to the vault, where he watched it get deposited in the client's allocated storage account. In other words, or I should say segregated storage account. In other words, taking customer service to a whole new level, which frankly I doubt any other dealer is doing, yet Andy does all the time. And when it comes to Brinks Montreal, where not only do Andy and David keep their personal metal, but I truly believe it is the best storage option, particularly for Americans, for a variety of reasons. As discussed thoroughly in the YouTube podcast posted last fall, titled Brinks Montreal Storage Program, interview with Andy Schectman, such as being the only storage program we are aware of that charges not by a percentage of bullion value, but on a per ounce basis. Generally speaking, as I have long emphasized, bullion storage is only necessary for a small percentage of gold and silver owners. For most, if you simply buy a safe, securely hide it in your house, make sure only need-to-know friends and relatives are aware of it, and supplement it with alarms, guns, and or dogs, there's no reason not to keep your metal at home. However, for those holding very large amounts, renters, expatriates, those who plan to frequently move, or who don't have friends or relatives they can trust it to its custodianship, or like myself are high-profile precious metal owners, storage makes all the sense in the world. So long as it's outside the United States of Big Brother, in a non-financial facility such as Brinks. On a personal note, as you can imagine, I am as financially paranoid as anyone on the planet, and thus, despite the obvious need for me to store my metal, I was still terrified of letting it out of my sight. However, given that the Brinks program is operated by Miles Franklin, just over the border in the relatively strong political jurisdiction of Canada, and most importantly of all, inspected regularly not only by one of the industry's leading third-party auditors, Bureau Veritas, but Andy Schectman himself, I am 100% sure that my metal not only is segregated but saleable and or retrievable at any time. In fact, I have been to the vault twice already, including once during an inspection, and seen my metal counted, making me as comfortable as I can possibly be. For more information on the topic, please give Miles Franklin a call at 800-822-8080, listen to the aforementioned podcast, or read my October 2014 article, Brinks Montreal, the world's best storage program. Why do I bring this up this morning, you ask? Because clearly, to the question I asked in my July 27th audioblog, has the big one commenced? The answer is a rousing, decided yes. Look no further than the industry-wide run on junk silver, or as I call it, the ultimate fear asset, which is no longer available at any price. And yesterday's largest ever one-day spike in the VIX volatility index, or as many refer to it, the fear index, if you think it hasn't. Much less the all-out carnage we have witnessed in commodities and currencies going parabolic, and finally overwhelming the hideous, until this week's seemingly all-powerful derivatives and high-frequency trading algorithms the powers that be have used to support equity markets. Just 2 weeks ago, I wrote that the only difference between late 2008 and today, that is, aside from tens of trillions of debt, bullet-riddled currencies, historic commodity oversupply that promises to swamp markets for years to come, and the broadest, most ominous social and geopolitical unrest since World War II, is the power that be's ability to manipulate and to support stock markets, and conversely, suppress gold and silver, i.e. the Achilles heel of the financials world. Well, this week those seals started to break, as even last-to-go manipulation strongholds like the Dow Jones propaganda average crashed heavily, joining the 23 global stock indices already in bear market territory, such as the supposed growth engine of the world, China, which plunged 12% in the last 4 days alone, breaching its 200-day moving average yesterday like a hot knife through butter, atop its worst PMI manufacturing reading since the height of the 2008 financial crisis in March 2009. Here in the U.S., where the concept of a government-led stock market plunge protection team was not only invented, but supposedly mastered, equities literally imploded, with the Dow plunging 1,100 points, or 6% from Monday morning's highs, including a whopping 540-point freefall yesterday, featuring, ominously, a 100-point panic-selling binge in the week's final hour of trading. The historic NASDAQ bubble was pricked even harder, down 3.5% yesterday alone, and 386 points, or nearly 8% from Monday's highs. Even permeable Jim Cramer, to my shock and dismay, given his position as head CNBC stock cheerleader, claimed Thursday night that the NASDAQ needs to fall 30 to 40%, yes, 30 to 40%, to reach a level consistent with his current view of fair value, given that, quote, it is full of downright insolvent companies. Which, I might add, is exactly what I have been saying all along, that current NASDAQ valuations, particularly in light of the horrific state of and outlook for the global economy, are, if anything, more egregious than in early 2000. As for the S&P 500, it has now surrendered all its post-QE3 gains, while it's crashing through the key round number of 2,000 like a molten hot knife through liquid butter. Regarding the Russell 2000, an index of, pardon my French, pure speculative crap, most of which is unprofitable, more than a third of it was already in bear market territory before this week's carnage. And lastly, and most ominously, the ultra-broad Value Line Composite Index not only sliced through its key moving averages like they didn't even exist, but actually broke the 6-year trend line going all the way back to the PPT-orchestrated equity bottom of March 2009. And speaking of March 2009, that's also the last time WTI crude closed as low as $40.29 per barrel, although at the time the CRB index never got lower than 200, as opposed to the horrific 191 close experienced yesterday, just 6 points above the 40-year low of 185, where it oh so briefly touched amidst the anomalous deer-in-headlights post-9/11 environment of October 2001. 10 months ago, when WTI crude was still $81 a barrel, I wrote, "Crashing oil prices portend unspeakable horrors," discussing how a collapse of the world's largest revenue-producing industry, in which everything from high-cost producers' drilling budgets to the spending of major sovereign nations is heavily leveraged, would lead to massive social and political unrest atop economic depression and collapsing commodity currencies. And in January's direst prediction of all, I discussed my belief that, based on the irrefutable premise of David Stockman's Great Deformation, commodity prices were headed for a deflationary hell unparalleled in history. And by the way, gold and silver owners, have no fear, as I also wrote an article emphasizing how they would be the big winners in such an environment titled Commodity Crash, but don't worry, precious metals are not commodities. But I'll get to that in a second, as first I want to focus on actual commodities, which are plunging so fast it's difficult to believe the entire world won't be reporting negative GDP growth in the third quarter, and far more so in the fourth. As for oil, it briefly traded below $40 per barrel, portending what will likely be a lengthy, horrifying trip through the 30s, causing not only billions of equity capital to vanish like the proverbial fart in the wind, but prompt energy-related bonds to plunge to record lows. Or I should say, prompted, as they did hit record lows yesterday. You know, the $500 billion of junk bonds and leveraged loans underlying the high-cost U.S. shale industry, which essentially will all be vaporized in the coming months. In fact, the last time oil prices fell for 8 straight weeks was 29 years ago, when OPEC grandstanding was the culprit, as opposed to today, when OPEC is essentially powerless to stem the tide, particularly following Obama's bogus peace deal with Iran, which before it has even been approved, has witnessed an Iranian production surge so dramatic the global supply glut has been nearly doubled. And it's not just oil, of course, but all commodities, which is why everyone from miners to E&P companies have been announcing gargantuan layoffs and capex reductions, which I assure you are just the tip of the iceberg regarding what's coming. As for base metal mines, likely a third or more of all global operations are hemorrhaging money as we speak, and just wait until Dr. Copper, or as I deem it, Dr. Death, approaches its 2008 low of $1.50 per pound, as well as 50 cents per pound for lead and zinc respectively. Remember, roughly half of all global silver production is the byproduct of copper, lead, and zinc mines, and thus, when they are inevitably, indefinitely mothballed or permanently closed, we are likely to see the utter collapse of silver production predicted in last year's Miles Franklin Silver All-Star Panel webinar, which you can listen to for free, like all Miles Franklin blog material, by simply Googling it. And oh yeah, another category of commodity freefall that few, if any, have been talking about, but I assure you will be shortly, is agricultural commodities. California and Brazil droughts notwithstanding, which I might add are worsening with each passing day, nearly all agricultural commodity prices are in freefall, such as, for instance, the farming staples of soybeans, corn, wheat, sugar, and oats, down 14%, 16%, 25%, 36%, and 37% respectively year to date, which is probably why John Deere reported a catastrophic earnings outlook Thursday, validating the mining equipment demand collapse Caterpillar has been reporting for the past 2 years. Few people realize that, eerily like U.S. shale oil, U.S. farming has recently fallen victim to the proliferation of subprime-style lending schemes, similarly catalyzed by the financial engineering lunacy fostered by unending ZIRP policy and the seeming market put of the aforementioned PPT mechanism. Which is why way back in May, I wrote the following. Violently volatile currency markets, i.e. the single most precious metal bullish factor imaginable, are destroying global trade as powerfully as the massive supply-demand deformation caused by 4 decades of unfettered money printing. And not just in mining, manufacturing, industrial production, and government infrastructure, but agriculture, where plunging prices of key foodstuffs like rice, corn, oats, soybeans, and wheat, acute water shortages in drought-riddled areas like California and Brazil, and the first farmland price declines in 3 decades portend a farming emergency in the very near term. And geez, I haven't even discussed lumber, which amidst the so-called housing recovery that in and of itself is but a figment of government statisticians' manipulations, with the only real semblance of strength in the 1% homes that have benefited from said ZIRP and PPT operations the most, lumber has plunged by more than 30% year-to-date, en route to commodities Hades, when the coming housing rout makes 2008's historic implosion feel like a walk in the park. Which, of course, brings us to the currency carnage created by collapsing commodity prices. How's that for a tongue twister? Which, as longtime readers know well, I predicted way back in December 2013, under the premise that a collapsing global economy would yield a surge in the dollar not due to U.S. strength, but the liquidity vacuum caused by fearful capital racing for safe haven assets. Which, of course, the dollar is decidedly not, but compared to lesser, weaker currencies, it most certainly is, at least so long as it maintains its dying reserve currency status. That said, even I am in awe of the accelerating implosion of currencies the world round. Ironically, as the dollar appears to have topped against major currencies like the euro, yen, and pound. And of course, the Chinese yuan, whose 6% devaluation last week, which I not only called contrary to essentially the entire world's consensus view back in April, but 12 hours beforehand in last Monday's upcoming cataclysmic financial Big Bang to end all Big Bangs. Unequivocally, in my view, this is the single most disastrous, portentous financial event of our lifetimes, as best described by the title of my article 2 days later, after the PBOC had devalued not just once or twice, but 3 times, i.e., 3 devaluations a charm, if charm is defined as collapsing commodities and exploding currency wars. Frankly, what the dollar does against said major currencies is a whole other story, as again, now that China has launched its nuclear salvo into the final currency war, speculation will become rampant as to which major central bank will devalue next. Regarding the ECB, BOE, and Bank of Japan, of course, they'll eventually increase their already historic QE programs, and in the ECB's case, NIRP as well, or negative interest rate policy. However, given they are already deeply entrenched in such programs, clearly the best bet is that the only such central bank not currently engaged in an overt QE scheme, the Fed, although I assure you plenty of QE is occurring covertly, will be next. Which I might add will be particularly damning from a credibility standpoint, given how they still, laughably so, are pretending to be considering raising rates. And this as market rates are plunging in freefall fashion, knowing full well the Fed's true intentions. Of course, as noted above, as we are nearing the point where the entire world realizes central banks not only can't save us, but are utterly destroying the world, don't be surprised if the inevitable economic Mother Nature-led interest rate surge that ends modern central banking once and for all arrives far sooner than most can imagine. And as for said commodity currencies, and for that matter, nearly all currencies not considered major, and some major ones as well, such as the yen, are completely imploding, yielding the terrifying who's next feedback loop that promotes further economically debilitating currency speculation, principally shorting, as ZERP-financed hot money bets on which currency will collapse the soonest, the most. To that end, I discussed the collapsing Fragile Five currencies 2 years ago, where a quarter of the world's population lives, of Brazil, Turkey, South Africa, Indonesia, and India, all of which have since imploded to new all-time low levels. However, back then it was only those 5 that received the bulk of investors and speculators shorting frenzies, as opposed to today, where in the aftermath of last week's Big Bang Chinese devaluation, let alone collapsing commodities and stock markets, articles discussing who's next have become as rampant as which internet stock will explode next articles in late 1999. Already, one of China's main manufacturing competitors, Vietnam, has officially devalued its currency in response, whilst rumors of when Japan and South Korea might follow suit are spreading around the internet like a malignant cancer. Moreover, currency analysts are creating myriad new currency shorting platforms, such as RBC Capital labeling Algeria, Iraq, Libya, Nigeria, and the already hyperinflating Venezuela as the Fragile Five oil producers. To that end, Bloomberg wrote an article discussing which currencies are among those most at risk from the conflux of global developments, including the Saudi Arabian Rial, Turkish Lira, Nigerian Naira, and Malaysian Ringgit, each of which is already free-falling and each of which possesses the ability to dramatically, horrifically impact the world due to the guaranteed ramifications of collapsing economic activity, bankrupt governments, and escalating social and geopolitical tensions. Which is probably why, coincidentally, the week's headlines featured story after story of the ominous events initially postulated in said crashing oil prices portend unspeakable horrors. Not to mention dozens of other articles predicting what would happen when the big one, which is here now, inevitably arrives, such as East Ukraine announcing a referendum to join Russia, as the U.S. considers additional anti-Russian sanctions, as if the collapsing ruble isn't enough. Syria and Israel trading airstrikes, Turkey on the brink of martial law and civil war, tens of thousands of protesters in Tokyo demanding Shinzo Abe's resignation, hundreds of thousands protesting in Rio de Janeiro demanding Dilma Rousseff's resignation. Ought to be an event-filled Olympic Games next year, huh? Escalating war tensions in North Korea, the prospect of Saudi Arabia facing a, quote, open revolt at December's OPEC meeting, and, oh yeah, the resignation of Greek Prime Minister Alexis Tsipras, accompanied by yet another snap election announcement 4 weeks from now. Yes, Greece, where no bailout was ever executed, other than the ECB printing a few tens of billions, handing it to Greece, solely so it could pay it right back, which, I might add, is the Ponzi scheme to end all Ponzi schemes. As I've said all along, there is absolutely no public will to allow such monstrosities to continue, particularly as the free-falling, insolvent Greek economy has nothing to lose by defaulting on its now 650+ billion of unpayable debt. To wit, when Tsipras betrayed the nation's unanimous oxy vote last month by agreeing to accept the Troika's terms, essentially of enough printed money to repay it on condition of Greece handing over all state assets, I said that if I were a betting man, I'd bet Greece completely collapses within 9 months. And now, mere weeks later, that day of reckoning appears to have already arrived, as evidenced by the stock price of the state-owned National Bank of Greece, which closed yesterday at an all-time low. To that end, if you want to gauge how close we are to the next far more deadly pigs crisis swamping Europe like the aforementioned unstoppable tsunami of reality, simply watch NBG's stock price, which I long ago deemed the world's most important stock of the world's most insolvent entity. Or better yet, simply look at the calendar, as fellow pig Spain's presidential election is in December and Portugal's in January. In Spain's case, we know that the Podemos party is going to win, with a very anti-austerity, anti-Euro Juan Pablo Iglesias as its leader. And as for Portugal, which is the second worst financial condition pig after Greece, who knows? And then there's gold and silver, of course, which despite some of the most blatant cartel efforts imaginable, were the week's biggest winners. Once and for all, as if the experience of 2008 and 2009 didn't prove it already, proving they are indeed the world's best safe haven assets. In the paper markets, far less manipulatable gold, due to its higher liquidity, performs slightly better, but in the far more telling physical markets, it is silver that, as in 2008, is causing the cartel the greater amount of stress. As noted in last week's Silver Supply as a 1.5 or 2.0 out of 10, we have reached the point that, as Andy Scheckman reiterated to me last night, we are on the razor's edge of tightness, which could easily morph into a 2008-like shortage condition in a heartbeat. You know, when every major mint in the world was sold out for months on end, with physical premiums surging to nearly 100% over the fraudulent cartel-suppressed paper prices. As I have been practically screaming for weeks, but particularly the last week, everywhere one looks, physical demand is exploding. Published above-ground inventories are vanishing, and mine supply, both current and expected, collapsing. This is why Miles Franklin is seeing its highest demand since the immediate aftermath of the April 2013 alternative currencies destruction paper raids, with, in recent days, shades of late 2008-like panic buying amidst the same fearful investors that caused the VIX equity volatility index to surge late this week at a record pace. Oh, and one more thing before I leave the topic. As I'm sure that some, having seen mining shares post a very modest rebound in recent weeks, will want to speculate in the world's most dangerous paper investments to capitalize on an expected precious metal rally. Notwithstanding yesterday's action, of course, when the Huey plunged just as much as the broad stock market, despite gold ending $7 an ounce higher. To that end, I cannot emphasize enough that since the spring of 2011, when, while still working at a junior mining investment relations firm, just before joining Miles Franklin, I started publicly warning investors of the risks of mining stocks, given my experience of owning them for 9 years and working for them for 5, which is that though they might one day rise materially, and then only under the most specific of market conditions, they would never have the potential to dramatically outperform the metal, certainly not when capital gains taxes and commissions are considered, and could easily be destroyed entirely, not only if gold and silver prices plunge, which they did, entirely due to cartel suppression, of course, but if they surge, given that when the cartel is inevitably destroyed, it will mark the beginning of the remonetization of gold and silver worldwide, and thus an era of government interest in precious metals that will undoubtedly yield mine nationalizations, windfall profit taxes, and any other equity investor negative issue you can imagine. And thus, I can only reiterate for the umpteenth time that if you want to preserve your capital and insure it against the oncoming catastrophic political, economic, and financial events, physical gold and silver are, by many multiples, your best bets. However, if you want to speculate in the most rigged financial markets in history, on the most establishment-despised sector in history, go right ahead, with the knowledge that you are just as likely to lose your shirt, in fact more so, on mining stocks than to make a killing. To conclude, if this week's events, and for that matter, this year's events, when excluding the until very recently maniacal government support of stock markets and cartel suppression of gold and silver prices, if they don't convince you that the so-called powers that be are not only moronic Keystone cops without a clue what they're doing, witness Paul Krugman's Atlas Shrugged-like article yesterday of how the biggest problem is that governments don't have enough debt, I'm not sure what will. That is, until said commodity currency and equity plunges grow exponentially worse, impacting your life in a negative manner you couldn't conceive even in 2008. Remember, economic Mother Nature always wins, and betting otherwise will likely cause you to not only lose your shirt, but potentially everything else dear to you. To that end, we can only reiterate as vehemently as possible that the time is now to protect yourself while you still can. Here at Miles Franklin, we have conducted business for 26 years without a single registered complaint and can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. Consequently, if you are considering the purchase, sale, or storage of precious metals, we simply ask you to give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. And by the way, don't think I don't see the comments about low volumes on these podcasts when listening to YouTube. Clearly, this is not everyone's problem, as some, like myself, hear them perfectly. That said, many are having such issues, which, trust me, I am working on hard to resolve as we speak, such as buying my new Yeti microphone and this week adjusting my VLC media player settings. Any suggestions you might have, as always, are welcome. Thanks very much.